Hi, my name's Simon Malumbi, and I run the Australian dollar cash and bond portfolios at SSGA in Sydney. And today I'll be walking you through our State Street floating rate portfolio. You can see on slide number 2 that the SSGA cash team, which I'm part of, runs on any given day assets upwards of 400 billion US dollars. Now, that's a substantial cash exposure in the global money market. And due to that exposure and the conservative nature by which SSGA run portfolios, we have our own credit team. So Attilio Quartieri, who is the Australian dollar cash credit analyst in Boston, works very closely with myself and Brett Purkis, who run the Aussie dollar cash and bonds. On the next slide, you can see the investment options that are available if you are running a cash style portfolio with cash objectives. So historically, the most liquid assets in the Aussie money market are certificates of deposit. And then as you move out through the yield spectrum, you have floating rate notes, you have mortgage-backed securities, and then you indeed have term repo, which is a secured loan, which delivers quite a lot of yield too. But the focus of this portfolio is unsecured bank issuance because liquidity is a main driver of the reason we put assets in this portfolio. On the next slide, you can see the implications for what is a very low interest rate scenario in Australia and indeed other countries on the back of the COVID and the Delta epidemic that we're seeing. Central banks are flooding the money markets globally with liquidity. They don't want another GFC style illiquidity or frozen market because we know the sort of ramification that has to other asset classes. So at the moment, interest rates globally are very low. It's very hard to garner any form of interest out of a deposit. And even bond funds are at historic low yields. So at some point, credit becomes very attractive, and the style of portfolio that we're showing you here, the floating rate portfolio, offers a very attractive coupon over BBSW because they are floating rate notes. On the next slide, you can see a graphical illustration of the extension of duration in bond portfolios over the last 10 or so years. 10 years ago, the composite bond index had a duration of 3 years. 3 years is your risk. So a 3% sell-off if you get a 1% sell-off in yields. At the moment, that composite bond index is running duration of 6 years. So the risk has doubled. So with central banks and with treasuries issuing bonds into the market in these historic low interest rates, and they're issuing longer and longer debt because they are taking advantage of very low interest rates and borrowing for longer periods at lower rates, the risk of fixed portfolios has doubled over the last 10 years. So we just like investors to be cognizant of that too, in that the risk they're running in their bond portfolios has doubled over the last 10 years. If you look at the next slide, money markets work by anticipating what central banks are going to do. Money markets work by anticipating where inflation is going to be. So you can see from this slide that although Governor Lowe and the RBA have been explicit in that official cash rates won't move until 2024, the market is already pricing that is going to happen in 2024. And even by the end of 2025, it is being priced at the moment that interest rates will be markedly above the 10 basis points where the official cash rate is at the moment. The next slide shows you the reflationary pricing is already happening in bond markets. If you take a yield curve and you look at the front 3 years, that's where monetary policy is going to be. And then the longer part of the curve, that's where the market prices inflation. So at the moment, we've got 3-year yields selling off a touch outside of the yield curve control bracket, which is the RBA controlling the April 2024 bond and end. After that, yields are well above that sort of 10 basis point line in the sand. And then also 10-year bonds, although they've been somewhat volatile, are selling off because the market is starting to price inflation, and that's where you get 10-year yields potentially a lot higher than where they are at the moment. The next slide compares floating rate notes to fixed rate notes and term deposits. Term deposits we're not a very big buyer of. In fact, we're not a buyer of because they're just totally illiquid and we don't like illiquid investments in the portfolio. Fixed rates, we run some very substantial bond portfolios, but for floating rate notes, which is what we're talking about here, in an environment where a central bank is increasing interest rates, or indeed a yield curve is starting to price anticipated monetary policy tightening, floating rate notes reset every 90 days, every 3 months, and that coupon ratchets up as the BBSW curve starts to price monetary policy tightening. The floating rate fund that we've been talking about has a return target of between 1 and 1.5% over the RBA annually. It distributes all income monthly. It's a very transparent, high quality investment grade portfolio. We only buy senior unsecured banks. And in this sort of low interest rate environment, when yields do indeed start to sell off and curves start to move higher with both inflationary pricing and tighter monetary policy being priced into it, a portfolio of this nature, the coupon ratchets up as the notes reset to a higher BBSW curve. As I said earlier, it's an actively managed portfolio. We do leverage off the expertise of the SSGA credit team that, as I outlined in the introduction, are instrumental in giving us limit buy lists where we can purchase banks that they have a lot of confidence in. And it's also an ESG aware portfolio in that we employ the R factor, which is a State Street proprietary indication of ESG strength within a company. The next slide shows you the debt hierarchy. And this portfolio only buys bullet maturity. So there's no weighted average lives. There's no sub debt. There's no potential extension risk. It's all bullet maturities. And when you say bullet maturity, it means there is a legal maturity. So we know when we get the money back from all of the bonds. And we only buy senior unsecured notes. So they're the most liquid in the market. They're the most senior out of the debt spectrum. And if there were defaults or if there were market events, this is the highest rated and first pick, I suppose, the pecking order of all debt instruments within that bank profile. This slide illustrates the active nature of the floating rate portfolio that we're talking about. It's an active portfolio construction process. It leverages off the SSGA credit team and the buy list that we're presented with, but there's also other dynamic factors within the portfolio, and they're factors that are driven by the global and domestic economic outlook, I suppose the positive feeling in the market, the negative feeling in the market, how the credit markets are behaving, are they liquid, are they illiquid, and also the issuance that we see in the market. So it's a truly dynamic, active portfolio that we are presenting here to you today. As I mentioned earlier, it's an ESG aware portfolio. It's not a green fund. It's not an ESG portfolio, but State Street engages the R factor, which is a SASB style ESG and sort of data reader for corporate names. And we have committed that this portfolio, through R factors produced internally, proprietary R factors, that we will not be buyers of banks that are either laggards or underperformers. And as you can see from that pie chart there, we do own outperformers and also, I suppose, average R factor performers. There's no laggards nor underperformers there. The performance table here, we have a return target of between 1 and 1.5% over RBA annually. We have done that since inception, and we're very comfortable with those parameters in the future. Although it's a very low yield, a very low rate environment, the way we have the portfolio structured and with both domestic and international bank issuance in the portfolio, the return target is still very achievable. It does distribute all income monthly too. So all income receipts, all coupons we receive in the portfolio are distributed monthly. Positioning in a diversified portfolio, it's a big question sort of in a lot of people's portfolios at the moment because short bond yields are very low. Is the risk of inflation being priced into markets apparent? Yes. And term deposits, illiquid, yields very low, banks low to issue. So, I mean, owning a floating rate portfolio of this nature allows you to position defensively for if there is a sell-off in yields, allows you to own a liquid investment that delivers coupon every month. And it really is a good fit for any sort of portfolio that needs monthly income and a liquidity parameter that offers liquidity every day. And the summary of the portfolio here is an average credit quality of A+, an average coupon of 80 basis points at the moment. We own 34 issuers. That's probably half Aussie banks, half international banks. Distributes income monthly. Available on a lot of platforms that you can see there. And it is a very well-diversified portfolio that has very low interest rate duration risk and runs spread duration of around about 3 years. And it's available on many platforms that you can see on this slide. And if you require further information, you can learn more at ssga.com, or you can also contact the managed funds at ssga.com email address for additional information on this portfolio. Thank you for your time.